To be able to manage something, you have to be able to measure it. In order to measure it, you need a starting point. I'm going to jump into, at a high level, what are the three major outcomes of the FP&A process here at GrowthLab. A lot of small businesses and medium-sized businesses, they think they can't afford to have a fractional CFO. They can't afford to have a financial analyst. But the reality is, most of you don't need a CFO. You probably don't need a financial analyst just yet. But what you still do need is, yes, good, solid bookkeeping and accounting, but layering on top of that a FP&A process, that's a financial plan analysis process that follows the same cadence and rigor that you expect from your accounting staff or your outsourced firm that provides you that service. The first thing is your annual budget. That's your annual operating plan. That is like par for the course for any FP&A process. To be able to manage something, you have to be able to measure it. In order to measure it, you need a starting point. And your annual operating plan, regardless if it's a January 1st or July 1st, it's your starting point for that fiscal year. A lot of things are actually connected to that annual operating plan. Think about your hiring plans. Think about compensation, bonuses, capital expenditures. Think about your go-to-market motions. You can't go to market and try to bring on way more business than you can actually service. So your annual operating plan, it's sort of like that box that includes all of the stuff that's about to happen over the course of the next 12 months. I like to build my annual operating plans. I like to keep them simple. I look at through the lens of what are the 5 major drivers of cash in, cash out. And then once you have a sense of what your cash flow pro forma looks like for the rest of the year, now you can move that and convert it into an accrual-based pro forma. Where do you start? I start by looking at last year's customer base. And I think about volume, okay? Can I acquire more customers? What does the market dynamic look like? We all know that the last 18 months was a little bit of a surprise for many. Coming into 2024, everybody was pretty stoked for another solid year of growth, but many got caught blindsided with customer churn, slower organic growth. Start with your volume, start with your current customer base. Can you acquire more customers, and what does that look like? Stay conservative. Next, think about service expansion. You did a lot of work last year building out your product line or new service lines. How can you penetrate your existing customer base with new service lines? And then the last piece is, don't forget about price increases. Inflation's been a real thing over the last 5 years. We all know it. And guess what? It's still a little sticky. Your cost of goods sold are going up. Your operating expenses are probably still going up. But your revenue, your prices has not kept up. So don't forget about that price. It's always healthy to revisit pricing once a year. Next, take a look at your cost of goods sold. What are you expecting? If you're a service-based business, you know that 80% of your expenses are in human capital. And human capital inflation is a real thing. Your people costs are going to continue going up. Now, the beauty is we're also in the midst of 2025, and AI automations is a real thing. If you haven't heard about it, check out our other team called Streams over at streams.io. That's what we do. We build AI automations and agents for small, medium-sized businesses. There's a real cost-benefit analysis to be done there, because although a lot of the AI agents are not ready for prime time to take over things, they soon will be. And now is a great time to start investing in some AI automations, especially around your cost of goods sold, delivering that service to your customers. Now, as you think about your cost of goods sold and your cost of labor, we talked about inflation, but what is your hiring plans? If you've got aggressive customer acquisition strategy going on, are you ready to bring on more team members? More team members also means it's an incremental increase in cost, which will impact your gross margin because you may need to layer on some management. The next big piece in your annual operating plan, of course, is your operating expenses. Rule number 1, keep it flat. Take a step back. Think about those initiatives like AI automation implementations and deployments. How much is that going to cost? Does it cannibalize other costs? Hopefully it does. It should. If it doesn't this year, it should next year. Otherwise, why are you doing it? And then once you're there, you got a good solid net operating profit, which in this case, if we're building this out on a cash in, cash out, forget about accrual accounting for a second, that is going to be your ending cash from operations that you can bank on in your bank account come December 31st. So that's your annual operating plan. Kept it very high level. First draft of this, it's okay. It's good. Your annual operating plan will always be wrong. It just needs to be directionally correct. The next piece is setting up your cadence. Here at GrowthLab, when we service our customers with FP&A, we look at it from the lens of an operations call and a finance call. Those two calls straddle your accounting close call. Your ops call helps feed your rolling 12-month cash flow, helps update the current month. In other words, the data you're getting from your ops call on that first or second week of the month pretty much means that current month should be fully baked on the dot. Next, you have your accounting close call. The purpose of your accounting close call is to make sure everything is nicely categorized and all your accruals are correct, because the last thing you want is some expenses still hanging out on your balance sheet. Then a week later, you have your finance call. That's where we begin to look at, here's what we thought we were going to do at the beginning of the year, your AOP. Here's what we thought we were going to do this month based on last month's update to the rolling forecast. And 3, here are the actuals. And understanding the variances. When I look at variances, I want to be able to identify systemic issues, something that totally blindsided you. It could even be that IRS notice that said, hey, you actually owe another $10,000. That's a big issue. That's a lot of money for many companies. But also I want to understand, did I push revenue out? Did I pull revenue in from the future to this month? Because that's gonna help you predict what the next month and the following months are gonna look like. I also like to look at what's called a vertical analysis from your MBA class, where I like to see each of the chart of accounts as a percentage of the total revenue. I even do that for the subsegments of revenue. What SKUs, what product lines, what service lines contributed to the whole revenue pool for the company. If I look at that over the course of, say, a trailing 6 months, kind of helps me understand where the trends are. And then it helps me predict when I'm in my ops call the following month, what I may tweak, pull in, push out over the course of the next 12 months. So there you have it, an annual operating plan. You have your cadence in place, and now you also have what you should expect from each of those calls tying back to your accounting. So if you enjoyed this video, please feel free to subscribe, and don't forget, we have plenty of YouTube videos around financial planning and analysis. Take a look.